Good morning, everybody. I'm going to give everyone just a few seconds to get logged in today. Good morning, everyone. Thank you for joining us today for New Year Better Market 2023 Outlook. Today, this session will cover key market drivers and investment themes we predict you will see in 2023. We do have the Q&A feature available, so you can submit questions through that option. And if there's time at the end of the session, those questions will get addressed. You can also submit any questions you have via email at marketing@yoursummit.com, and I will display that email address again near the end of our session today. And so now I'm going to pass it off to Casey Schedule to get us started.
Well, thank you, Riley, and thanks everyone for being on today. I am so excited for y'all to get to hear from Gene Goldman and our very own Peter Reardon. But before we do, we want to just take a moment and say thank you. Summit's going to be celebrating our 35th year as a company in May, and we really could not have achieved this milestone without you, our valued clients. I really do trust that this new year is off to a fantastic start for each of you. And as I remember, while our team guides you, as a reminder, while our team guides you on investments and that Summit is a full service benefits firm, we really do want to continue to be that trusted resource for you, from benefits to risk management, insurance and consulting, and of course, all things retirement and personal planning. So we're grateful to each of you, whether you're a valued 401k or 403b client, or a participant that's in a company sponsored plan, or if you are working with our team on an individual basis. We know without you, we wouldn't have clients to serve. So we just want to say thank you. I did want to share a real quick story before I turn it over to Peter. A few weeks ago, a friend of mine who works at a law firm, and their firm's actually been a client of Summit's for 21 years. She told me that she gets to retire, and she has worked for 53 years. And she told me, it's all I've ever known, Casey. So I sent her a congratulatory email, and her response back to me is, I am excited, sad, scared, all of these feelings, but it's time. And so it honestly kind of like, it took me aback, but I'm curious. I want to ask you all, my friend is having mixed emotions about retirement at almost 70 years old because it's all she's ever known. She's worked from the age of 16, she said. So when you get to your retirement, are you going to be sad, excited, scared, prepared? If you are in retirement, you've also got to figure out, like, what am I going to do with my time? And so I can tell you that for most people, retirement looks different. Some people get the freedom to do exactly what they want. And I know that other people just barely make it. At Summit, we don't want you to have to worry about retirement. It really should be a time of joy, of celebration, but it is that change of course for your life. So I'm hopeful that at Summit, if we've done our jobs and we've been working with you as one of our clients, then whenever you're meeting with our team, you're going to say, yes, I have that freedom to use my time how I want it. And I don't know if you're aware, but our mission statement is to help people secure a healthy financial future. And so that always runs through my mind as we get to help people. So I just want to give you something to think about as this new year is starting. I want to ask you to call us if you have no plan, if you haven't engaged yet with our team about your financial future. You can either type it in the chat, you can shoot me an email, but I do want you to get to be like my friend. I'm excited. I'm a little scared for the unknown, she said. She's sad to leave her friends and colleagues and her work life, but she does get to retire. And so I'm curious, what are you going to say when it's your turn to retire? So that's just something that's been on my mind, and I felt like it'd be a perfect example for y'all just to be thinking about as Gene and Peter are going to be sharing today. So we do have two panelists with us today. Gene Goldman, he's back again to speak with us, as well as Peter Reardon. So Gene is a CIO with more than 29 years of experience in the development of investment strategies, money manager research, and overseeing investment analysts. He is frequently cited in the Wall Street Journal, Bloomberg News, the New York Times, Forbes, CNN, and Rutgers, and he is a regular guest on high-profile news networks like CNBC and Fox Business News. And our second panelist is our very own Peter Reardon. And Peter is an investment advisor representative, serves as an analyst at Summit. He holds the accredited investment fiduciary designation. He's a graduate of the University of Tulsa with a degree in economics and finance. Peter focuses on researching investments and the capital markets. His research informs clients on key topics in the global economy, and he uses that information to analyze fund data, both from a quantitative and qualitative perspective. And with that, I want to pass it over to Peter to kick this off. Peter?
Yeah, absolutely. Thanks for the introduction, Casey. Personally, I can't wait to get this conversation going and hear Gene's insights on the unique market and economic conditions that we've been experiencing. And I mean, what a year that 2022 was. By all means, challenging, but also fascinating for an analyst like myself. Casey and I did a bit of a Q&A webinar session back in October of 2022, and I highlighted the fact that almost all asset classes were negative. And that's how 2022 ended, with over 90% of all asset classes losing money. That's troubling for investors, but it also creates potential opportunity going forward. When we look back on 2022 and the various economic and geopolitical issues we had, I actually think we can understand why the asset market struggled so much. The Federal Reserve raised rates at an incredibly fast pace from 0% all the way up to 4.25%. We saw headline CPI inflation exceed 9%. We saw a lot of uncertainty geopolitically with the war between Russia and Ukraine. And we saw consecutive quarters of negative GDP growth, fueling a lot of talk around the possibility of recession and creating what's considered to be the most anticipated upcoming recession among professional forecasters. But as we turn a leaf into the new year, even though a lot of the issues that affected markets in 2022 remain factors, our outlook for how the year plays out isn't necessarily the same. And that's where I want to turn it over to Gene to walk us through where we are and potentially where we're going. So I'm excited to hear Gene's views as he works through his prepared slides. I'll be chiming in some questions and thoughts along the way. And if anyone in the audience does have questions, please feel free to submit them via that Q&A function or email them to marketing@yoursummit.com. So at this point, I'll go ahead and turn it over to you, Gene.
Awesome. Thank you, Peter. Thank you, Casey. Thank you for the introduction. So I'm here to talk about our market perspectives. And obviously, Summit, we work very closely in terms of providing market perspectives to help you in your portfolios. We work very closely. And it's a very much of a relationship where we discuss different investment ideas and different perspectives. And I mean, it's just excited to be here today. So what I'll do is talk about our market perspectives. And I've called it sort of bad news than good news. And I know it sounds kind of scary, but it's important because it's sort of how we expect the year to progress throughout 2023. So as I go to my next slide, so if we take a step back, I know I've talked to you a couple of times last year, but going into 2022, we laid out 3 investment themes or market themes. Number 1, economic growth would slow, but remain above pre-pandemic levels. And we did see that growth has slowed down. Number 2 is the Fed needs to be aggressive. I know Peter talked about this before. The Fed is super aggressive. They raised rates from 0 to the level of 4.25 to 4.5. Very, very aggressive. We'll talk about that. But again, the Fed proved to be very aggressive to address inflation. And number 3, market volatility. Markets are going to be swinging like crazy. We said this in 2022, and we do believe that for 2023. So 2022, our market themes played out. But the stock market and the financial markets did not really perform as most had expected. While we thought equities and bonds would be weak given the uncertain environment, given the high valuations, no one would have thought that we would have seen a tough year like we did last year. And I know Peter laid out some of the ideas, but think about this. The S&P 500, which is that big, broad benchmark of stocks, down 20%, about 20%. The safe areas of the market, like bonds, were down. The 30-year treasuries, one of these most safest areas or most safe areas of the world, down 33%, worst year on record. That traditional 60-40 portfolio, like 60% in stocks, 40% bonds. That fell 24% last year. The worst return for this mix since 1930. So tough year. And I think the only thing that did well, and obviously, Peter, you've done a ton of analysis on this, but the only things that did well last year, cash, gold, and oil. So very, very difficult year last year. So if I turn to 2023, our three themes are this. Market volatility will continue. Today is a great example. You look at this. The Dow Jones Industrial Average was at one point up 200 points. Now it's down 100 points. Big swings in markets. Expect this to continue. Number two, the Fed may pause, and we'll talk about the Fed. I think Peter and I are going to spend a lot of time covering the Fed, but the Fed may pause. What does that mean? What does that mean when people like me, like Peter, say the Fed is slowing down, they're pausing, they're pivoting? We'll cover all that. Number three, upside surprises are possible. As the economy goes towards the most anticipated recession that we've ever had in the history of our country, the data gets people get pessimistic. This creates the opportunity for upside surprises. So those are our three themes. I'll spend some time talking about the themes, but more importantly, I do want to talk how we think the stock market will perform throughout the year in terms of the fact that we think in the first part of the year, it'll be maybe a little difficult, lots of volatility like today, but second half of the year will be much better. So let me jump right in on that. So, and I hate this. This is a terrible slide, the bad news. And what I want to do is talk about the three things likely to pressure stocks in the first part of the year. And when I say bad news, this just means market volatility, this uncertainty, this jitteriness of what the markets are going to do. So the first one is valuations. I know this is a complicated slide and this is a lot going on, but I'm an analyst. I'm a geek. I went to the school for engineering. I'm a geek at heart. So I like to show data and stuff like that. So I apologize, but this slide, first of all, our first concern for the early part of the year is that valuations are pretty high. So you think about people like Peter and me, we analyze markets, and what we do is we look at valuations. And one simple valuation measure is price earnings ratio. It's the price of the stock market divided by the earnings of the stock market. If it's higher, stocks are more expensive. If it's lower, stocks are cheaper, generally speaking. And right now, the PE ratio on the S&P 500 is about 17.5. Last year at this time, it was about 22. Good news, it's lower than it was last year. But the problem is that the PE ratio is still very, very high, especially when you consider high inflation and high interest rates. You look at this chart, again, it's a busy chart, but it shows two things. The purple line is the S&P 500 PE ratio, price earnings ratio. The blue line is what Peter talked about, inflation. And what you see is that usually when the PE ratio is at this current levels, which I put in circles, inflation and interest rates are much lower than where they are today. Right now, the stock market, although valuations are lower than they were last year, they're not really reflecting the fact that we still have high inflation and high interest rates. So this is our first concern right now. Valuations are lower than they were last year, but they're still pretty high. High valuations price in almost near perfection. Everything has to go right. This is what concerns us. The second concern, and I think Peter and I will spend the most time on this, is the Fed. And we've talked about the Fed before, and the Fed is the Federal Reserve. And remember the Fed has a dual mandate. And the dual mandate is that they want to make sure that we all have jobs, and they also want to make sure that prices are stable. The good news, we all have jobs. I know there's been some layoffs lately. I saw like tech companies are laying off a lot of people. You're seeing other issues. Layoffs are starting. But the good news, we have jobs, and I'll talk about jobs a little bit later, but everyone has jobs. The second part is that they want to keep prices very stable. And what they do is that they have a bunch of monetary tools at their fingertips. And one big tool they have is called the Fed funds rate. And what happens is that if the economy is going too fast or there's too much inflation, they raise the Fed funds rate. And what happens is that they raise the Fed funds rate, other interest rates go higher, like bank loans, like auto loans, like mortgages all move higher. And this theoretically slows the economy down. This theoretically slows down inflation. And that's what the Fed is doing right now. So you look at this chart, and this chart shows that Fed funds rate that they move up and down. It shows over the last few cycles where they've raised rates and cut rates, raised rates and cut rates. What you see immediately, if you look at that second hump from the right, that kind of from 2016 to 2019, back at the last time the Fed raised rates before last year, it took the Fed about 3 years to go from zero interest rates, all the way to 2.25 to 2.5. 3 years. Last year, it took the Fed 5 months to go from 0 to 2.25 to 2.5. Today, rates are at 4.25 to 4.5. So rates have moved significantly higher. And again, this makes sense. The Fed is looking to address this inflation. As Peter said before, inflation was over 9% at one point. The good news, it's rolled down to about 6%. And we'll talk about inflation later. But the Fed is very aggressive right now. The Fed is raising rates dramatically. If you look at this chart, and this is we should call the Gene presentation of confusing slides, but this is another confusing slide, but it's important. What this slide shows is the dot plot. And the dot plot is this term for a document that the Fed creates that produces once a quarter. It's called the Summary of Economic Projections. And what this is in a nutshell, each Fed member anonymously says, okay, where they think interest rates are going to go, where they think inflation will go, where they think the economy will go, the labor market will go. And basically, it's called the dot plot because they put these dots on this chart right here. In red is where the Fed said rates would be at the end of this year, 3 months ago. So back in September, they said at the end of this year, the end of 2023, that they expected the Fed funds rate, that big shift that the Fed uses, would be at 4.6%. 3 months later, the dot plot that came out in December, the Fed now says 5.1% at the end of this year. So all this means in a nutshell is the Fed still plans to raise interest rates. There's a Fed meeting coming up on February 1st, and the market expects the Fed to raise rates by 1/4%. At the end of the day, the Fed has raised rates a lot. The Fed is continuing to raise interest rates. But, and here's the important but, the markets don't believe the Fed. They don't believe the Fed. The markets are saying, Fed, I don't know what you're thinking. Look at the economy. Look at the layoffs. Look at the fact that you've raised dramatically. So you look at this slide. This is what the bond market is saying. We expect at the end of this year, the Fed funds rate, remember that rate that the Fed uses, to be at 4.5%. Remember, the Fed is saying, we say it's going to be 5.1. The market is saying, 4.5. Also, the market is saying that we expect the Fed funds rate to be at its peak, to be at its high in June. And the Fed keeps saying, no, we're going to keep raising it beyond that. So at the end of the day, there's a big disconnect between the Fed and the market right now. If you look at the bond market, and the bond market is saying, we don't believe you at all, Fed. We don't think you know what you're doing. And this slide shows it perfectly. So what this shows, it's called the 2-10 or 10-2 or 2-10 spread. So I know we've talked about this before, but let me remind you. So the 2-10 spread, you have 2-year treasury yields and 10-year treasury yields. And in the world of investing, if you invest with someone for 2 years, you get paid less than if you invest with someone for 10 years. I know I made some assumptions, but you get it 2-year and 10-year. So 2-year yields should be lower than 10-year yields. What happens is that if all of a sudden the 2-year goes higher than the 10-year, and this can occur when actually, let me say something. The 2-year is a great proxy of what the Fed funds rate, that Fed interest rate, will be 1 year from now. So as the Fed is raising rates, this puts upward pressure in the 2-year. But then the bond market says, hey, you're slowing the economy down. This puts downward pressure on long-term rates. You have what's called an inverted yield curve when the 2 is above the 10-year. And you see this chart here. This plots the difference between the 2 and the 10. When it goes past that horizontal line, the 2 years above the 10-year. And this is very concerning for the economy. Think about it. If you're a bank today, you're a bank. You borrow money from us savers at these short-term rates, but theoretically you're lending out at these long-term rates. You're not making money. You start slowing lending, you start slowing down economic growth. This is why a 2-10 spread, which you hear quoted all the time, is such an important indicator to look at. But the long story about the slide, the market, because the 2-10 spread is so inverted right now, the market does not really believe that the Fed is done, that believes the Fed should be done right now. It doesn't believe the Fed.
Yeah, so Gene, just real quick, with respect to rates, can you just quickly, sum up for a moment, why has, the Fed risen rates as aggressively as they have? How does the way that they've risen rates in that aggressive way help accomplish their goal? And then also, you mentioned this disconnect between where the Fed believes rates will go versus the market expectations. And I tend to think we're going to see the Fed get up to around 5% and then hold there for at least the remainder of the year. To me, the Fed really doesn't want to repeat the mistakes of the 1970s. And so I think they'll get to 5% in the first half of the year and then keep it there for the remainder of 2023. my thoughts that the market isn't respecting the Fed's conviction on getting inflation normalized enough. So I would just ask you, Gene, what camp are you in there? How high do you believe rates are going in your opinion? And then when do you potentially see the Fed pausing rate hikes?
So Peter, based on your comments, it sounds like you're putting your hat in to be a member of the Fed. I think there's rumors that Lael Brainerd will be leaving the Fed, but so get your resume ready.
Don't fight the Fed.
Let me go to your first question. Why has the Fed been aggressive? And clearly, if you go back to 2021, if you go back to 2020, we have a recession in early 2020, COVID-led recession, 2-month recession. In that recession, what happened? It was the shortest recession in the history of our country. Supply chain issues. You had people earning more money than they did before during a recession. In the 2020 recession, we have never seen a recession where people actually made money. Usually you lose jobs, income comes down, income actually rose during a recession. So you have people who aren't flying, aren't vacationing, at home spending, buying, supply chain issues. This puts upward pressure on goods, puts upward pressure on inflation, surges dramatically. What happened is that the Fed in 2021 said, oh, you know what, this is transitory, this inflation will go away. And then they misinterpreted rent inflation. Rent inflation, we'll talk about that later. They misinterpreted the surge in rent and how sticky rent inflation was. This surged dramatically and the Fed kept saying, hey, inflation is going to be transitory, it's going to go away. Then in November of 2021, the Fed came out and said, we made a mistake. It's not transitory. And we're going to start to look at reducing inflation. So what the Fed has done is raise rates aggressively. And going back to the dual mandate, if inflation is high, they raise rates. The Fed tries to slow down the demand side of the economy. In Economics 101, you have supply and demand. When demand and supply are not in unison, if there's too much demand and too little supply, the Fed tries to slow down demand by raising rates. They were really affecting the housing market, affecting auto loans, for example. This puts downward pressure to ideally line up demand and supply together. Fortunately, what was causing inflation to move higher were supply issues, supply chain, lack of toilet paper, lack of hand sanitizer, lack of eggs today. I mean, we can't get it right. So all this together is really what's caused the Fed to raise rates dramatically. To your second question, if you look at what the market is, what the Fed is saying, the Fed is saying we're going to 5.1. If you kind of play this through, that means they're raising rates by 0.25% in February 1st, 0.25% in March, and then we'll see what happens. And I think the next meeting is in May after that. We'll see. I think I'll have a better idea after the comments from this next week's meeting, because they'll get a lot more data. Next week is going to be such a pivotal point for the Fed. You've got the ISM data, which we'll talk about later. You also have payroll report, and you have the Fed meeting, and you're seeing a lot of weakness already in the economy. Think about this: November and December retail sales were down. Those are the two best years of the month in terms of holiday sales. People aren't spending as much money. The economy is slowing down. So I do think I hate to be this, but I kind of got right being in the middle, but I do think that Fed funds rate will be in between where the market's pricing in and where the Fed is right now. Not as aggressive as the Fed says, but coming down a little bit. But more importantly, to your point, staying at that elevated level for a long time, because Powell has come out many times and said he didn't like how the Fed used to raise rates, cut rates, raise rates, cut rates. Kind of wants to raise them, keep them here for a while, and like fewer gyrations in that. So I know we're getting in the weeds here, but it's important because the Fed is so important. Because as you started to say before, there's the old adage: bull markets in the stock market don't die of old age, but rather they're killed off by the Fed, and the Fed makes mistakes. So great question. So the Fed is raising rates. They're slowing down. They're really slowing down inflation. It's good news there. The other impact of raising rates is hurting the economy. And this is what concerns us in terms of the uncertainty about the first part of the year. Another slide here. This is from the dot plot, the Fed dot plot. And what I've done in circle, I showed you that in September, the Fed expected economic growth for this year to be at 1.2%. Then in December, they cut that down to 0.5%. Higher rates are starting to impact the economy. You're seeing this. I mean, you're seeing housing market is slowing down, autos, everything is starting to slow down, retail sales, all the things I showed before. The economy is starting to slow down. It's because the Fed is raising rates to address that demand supply issue. The question, though, is, are we headed for a recession? Is it the fact that the Fed makes a mistake and pushes us into a recession? And the probability is pretty high. You think about this, in the last 15 times the Fed has raised rates, these rate hiking cycles, there's been a recession in 11 of the last 15. So recessions tend to be associated when the Fed raises rates. If you look at the data out there, there's so much data that says a recession is probable. You look at the fact that savings rates have dropped dramatically. Credit card purchases are rising. You look at this slide. This is what's called PMI. And PMI, and I know we talked about this last time, but PMI, as a reminder, it stands for Purchasing Managers Index. It's a survey, a monthly survey of purchasing managers, and they're asked questions. How's business? How's hiring? How's firing? How's competition? How are supplies? How's just business? How's new orders? And the data gets squeezed together. Above 50, it's expansionary. Below 50 is contractionary. We took two subcomponents. New orders and new orders within PMI are both below 50. Clearly, the economy is slowing down pretty quickly. So again, this is what's concerning for the market, is that the data is slowing, that we are potentially headed towards a recession. So the question that we get from a lot of you is, hey, if we have a recession, when do we have a recession? And if you kind of look at two data points, it gives you an idea when a possible recession is. And again, I'm not trying to say a recession is definitely coming. We could be wrong, but we're saying that there's a good probability of a recession occurring. So when does a recession occur? Two data points. Number one, it takes about 12 to 15 months for a rate hike to be fully felt by the economy. So the Fed started raising rates in March of last year. You pull that forward to this year, you're looking at about maybe the second quarter of this year, maybe the third quarter. The other data point you can look at is called the Leading Economic Indicator Index. And you see this right here. What this is, it's 10 indicators that are squeezed together that are very forward-looking, like average hours in manufacturing, jobless claims, building permits, consumer expectations. 10 indicators are squeezed together. This index is so important because it tends to peak about 13.7 months in advance of a recession. So if you see this on the far right-hand side, this indicator has peaked from February of, it's gone from February of last year down every month since February. So if you take that perspective, you're looking at maybe a recession, if we have one, but maybe a recession in the second or third quarter of this year.
Yeah, so Gene, let me stop you right there for just a moment. It sounds like recession is very possible, if not probable. And even thinking back to the idea of this being one of the most widely anticipated recessions ever, there's an old saying that when all the experts and forecasts agree, something else is going to happen. And even though I'm generally in consensus with a recessionary outlook, my thought as well is that it still isn't guaranteed and that maybe a softer landing is at least still possible. So, Gene, what would you say that the chances of a recession not materializing are, and what would have to happen for that to be the case?
Yeah, that's a great question. So there's a lot of reasons why we may not have a recession. I mean, I think today is a great example. Today we saw GDP come in. So GDP is US economic growth. It came in for the fourth quarter at 2.9% above expectations. That's good news. Jobless claims came in at 190,000, well below expectations. So the data is still pretty strong. But the problem is that that's a lot of that's backward looking data. Like, for example, in the fourth quarter, GDP up 2.9%, but then you've seen weakness in sort of these PMI data, leading economic indicators like I have here in the slide here. So I do think that there's a high probability of a recession. The data is slowing pretty fast. I think we'll get next week, we'll get really good data indicators in terms of the first look at the January economy, which is we need to see what's going on, especially given the weaker consumer. And even some of the numbers that we saw in today's GDP number were not that great. Yes, the headline number was above expectations, but consumer spending was pretty strong last quarter. But we know that in November and December, it slowed down pretty quickly. We also got a boost from inventory buildup. Basically, that's good news, but it's also bad news because people aren't buying as much. So we'll see what happens in terms of the second quarter. But I do think there's a good probability of a recession this year. But the good news we'll talk about later. If we have one, we think it's going to be mild, very mild. Great question, Peter. Okay, so bad news first part of the year. Number one, valuations are high. Number two is the Fed uncertainty. Number three, earnings. Okay, earnings are what drive stocks. I know we learned this in Investing 101. Earnings drive stock prices. If a company generates more earnings, generally speaking, investors buy the shares of those stocks. Earnings drive stocks. The problem is that if you look at FactSet, FactSet is this big data company that compiles all this earnings data. At the end of last year, or September of last year, they said earnings for this year would be about 10.2%. If you look at the data today, this is a little dated. Right now, FactSet expects earnings to come in at about 3.2%. We do believe earnings need to be revised lower. And you're seeing this already. You're seeing companies come out already for the fourth quarter and say earnings were great, we beat expectations, some big high profile names. But then if you read in some of the reports about future expectations, they're saying, oh, sales volumes we expect to decline. We expect other things to impact earnings. They're starting to revise lower some of their expectations. We do think earnings will be revised lower. Profit margins are under pressure right now. I think 2 years ago was the peak in profit margins of about 13% for the S&P 500. Today it's down to about 11.2. Sales volumes are declining. Margins are going to be weakening at higher costs. Also, inflation, which has helped keep revenue high because companies can raise prices. Revenues are starting to roll over. Inflation is starting to roll over. Revenues are rolling over. Our third concern is that earnings uncertainty will pressure stocks. So those are the three things for the bad news in the first year. Number one, valuations are high. Number two, the uncertainty around the Fed potentially pushing us into a recession. And number three is earnings. Earnings are the driver of stocks. So Peter and I, as you know, are very optimistic people. We want to talk about some good news, and that we gotta get the bad news out of the way. So let's talk about three things. And I know we're getting a little short in time, but three things why the second part of the year should be better than the first part of the year. And I'm not saying that the first part of the year is like we'll have nastiness in the stock market. All we're seeing is lots of volatility and maybe some weakness, but second half of the year should be better. First reason why the second half should be better is that we have lower expectations. So think about this. If we go towards a recession or the data slows down or earnings are weak or valuations are high, what happens? The economy slows down, expectations start to get revised lower. Pessimism hits the market and basically the data gets pretty bad and investors and economists are like, oh, I'm very pessimistic about the economy. And here's an example. You look at this slide. This slide shows what's called the Economic Surprise Index. It comes from Citigroup. And every time a data point goes above expectations, the line moves higher. Every time it misses expectations, it falls. You look at that gray shading on the far left-hand side, that's a 2020 recession. And you see expectations fell dramatically. But then the pessimism was so negative, data started to get a little bit better because it became easier to beat. When it becomes easier to beat, it drives earnings, it drives stock prices. So again, we do think that pessimism will drive into the stock market, drive into the economy, making expectations easier to beat in the second half of the year. The second reason why we believe that the second part of the year could be a little bit better than the first part is that inflation could prove transitory. The Fed could be right. The Fed could do a great job. We talked about this. Peter and I have talked about this. The Fed is being super aggressive to rein in inflation. And it's very important for the stock market. I'm not going to spend too much time on this slide, but basically all this slide shows is that there's an inverse correlation between inflation and stock prices. When inflation is high, stock prices go down. When inflation comes down, stock prices go higher. We do think the Fed is going to do a good job to rein in inflation. And if you think about the Fed is fighting inflation. They're raising rates. Remember the Fed funds rate, they're raising it, slowing down that demand, slowing down purchases, slowing down inflation. But regardless, the Fed is also being helped by a ton of deflationary pressure out there. Used car prices are falling. You look at this slide, this is inventory divided by sales. When inventories are slowing down, when inventories are being built up because sales are slowing down, the line moves higher. You can see that inventory to sales levels are so high right now. They've come down because basically sales are starting to slow down. But at the end of the day, retailers are cutting prices. This is putting downward pressure on goods prices. This is good for pushing down inflation. Commodity prices, oil, gas, natural gas are down. I know gas has risen a little bit lately, and we're watching this carefully. In the last week to 2 weeks, it's gone up a little bit. But more importantly, it's in a long-term downward trend. You look at this slide, natural gas is down 60% since August. Commodity prices are falling. This flows into headline inflation. It also flows into like production costs and so on. The third area that the Fed is being helped that in terms of disinflation is rent. And I know that Peter and I talked about this at the beginning. Rent is such an important thing right now because rent is a huge component of inflation. And if you go back to the pandemic, what happened is that everyone wanted to buy a house. Working from home, you wanted to live at home, you wanted to work at home, you want to do all that stuff. So people were moving away from cities, buying homes, and they're chasing homes, pushing up home prices. Home prices surged 31% in 2 years. But what happened is that first-time home buyers, which are about 30% of the market, said, hey, I can't afford these houses. I'm going to go and rent. So you start to go and rent apartments. What happens? Landlords are like, all right, I've got tons of apartments here. I'm going to start raising rent because everyone wants to rent my apartment. So what you saw is that rents surged dramatically, which flows into inflation, which puts pressure. The problem with rent is that rent is very sticky. It's very easy for landlords to raise rent, but they're not going to knock on your door and say, hey, CPI was down a little bit, was down 0.1% last month. I'm going to cut your rent by 0.1%. That does not happen. It's a very, very sticky inflation. The Fed realizes that they made a mistake in terms of understanding how much rent was contributing to inflation. The good news is that rent is slowing pretty fast. So not rent in existing properties, but new rent, asking rent. So what we did is we went to a website called apartmentlist.com, compiled all this data to say, okay, new properties being listed for renting, where is rent going? And you see on the right-hand side, rent has fallen now for the last 4 straight months. It's annualizing down to about 1.4%. So overall, rent is slowing pretty quickly, which flows into services inflation, which helps the Fed.
Yeah, Gene, I think that this is one of those topics that's really top of mind for investors, in inflation. And you alluded to it earlier, but for a while before the Fed started raising rates, we heard from them that inflation, it wasn't a big deal. It's transitory. It'll go away on its own, et cetera. But that didn't pan out. And personally, I do believe we're in a bit of a different situation now where some supply and demand issues have eased, economic growth is slower, and the Fed has, of course, taken actions with rate hikes that'll continue to help bring inflation down. But Gene, can you just quickly sum up what has changed to make us more confident in inflation normalizing now relative to, say, 18 months ago?
Yeah, it's going back to the Fed raising rates, aggressively raising rates, slowing down the demand. You look at housing is in a recession. You look at autos are still struggling. So the demand is slowing down. This puts downward pressure on demand. And then again, the Fed doing a great job in terms of raising rates. But then the other part is that they're just benefiting from disinflation trends. So like we talked about before, this is going to help the Fed. This is really driving the Fed dramatically. So it's good. It's good news there. So we see inflation. It's elevated, but it's going in the right direction, which is great. Knock on wood. So, okay. So good news for the second half of the year. Number one, lowered expectations are easier to beat. Number two, the Fed is doing it right in disinflation. The third point is something to think about. Maybe Peter and I are wrong. I know that the majority of people in our shoes think a recession is coming. I know that there was a Gallup poll that came out, I think 3 weeks ago, that said 79% of Americans expect a recession in 2023. Maybe we're all wrong. Maybe there is no recession. That's a possibility. And if you look at this slide shows the Atlanta GDP now. It's an estimate for GDP. And basically, it said that going into the fourth quarter, expecting around 3%. And we saw today's number came in for GDP at 2.9%. Pretty good. Consumers doing pretty well. Business spending is strong. Loan growth is pretty strong. Maybe we don't have a recession, because to go from this level to negative in 2023, it's going to be pretty tough. So maybe there is no recession. But with that said, let's say we still have a recession. The good news is something that Peter and I have talked about so many times, is that recession, if we have one, likely to be mild. Because first of all, I think the most important point is that you look at this slide here. Actually, I'll just tell you, it's kind of complicated. There are 3 million more jobs out there, like 3.5 million more jobs out there than people looking for jobs. Unprecedented. So everyone can get a job that wants a job. I saw a headline today on Bloomberg. Tech layoffs are hitting the tech industry. Makes sense. But I also saw the second headline that said most people laying off are finding tech jobs pretty quickly. There are so many jobs out there. Anyone that wants a job can get a job. Anyone that does not want a job can get a job. There are so many jobs. The good news, this provides stability in terms of a potential mild recession, because we're coming off a very strong base in labor. The second point why a potential mild recession is housing. Housing is in great shape. I know housing is in a recession right now, but we don't see a sharp sell-off at home prices like we saw in 2008. Completely different story. Right now, we have low debt to income, low mortgage debt to income. Product risk is not there anymore. You don't have balloon payments, teaser rates, no income verification. 90% of mortgages are 15 or 30-year fixed. They're amortizing. You have low inventories. And this chart, I think I've showed this to you before, but owner's equity is about 70% on average in homes. That means that if prices pull back, and they will pull back, prices are going to start slowing down. They have to. But even if they pull back, this is not like 2008 where prices start falling. And then owner's equity is so low, people are forced to sell. You see that little hump that goes down on the far right-hand side. That's like 2008. That's when basically low owner's equity because people were using these structuring tricks. So we don't see that. So we do think housing will be impacted, but nowhere is it going to cause us a steep, stark recession because housing is coming off a very strong foundation, pun intended. So the third reason for a potential mild recession is this whole concept of a rolling recession. Really, what this rolling recession means is that not the entire economy gets hit at once. Instead, only parts of the economy. So right now, what's in recession? Housing, autos, manufacturing. What's not? Consumer spending, especially on services. Try getting a flight right now. You know how expensive flights are? Energy is not in a recession. Lending, capital spending. So we envision a scenario where the parts of our economy that's in a recession right now, they start to recover, other parts go into recession. Not like a 2008 where everything fell, not like a 2020 where everything fell, a recession that rolls through the economy. Overall, it's a potential recession that the economy is down, but not in dire straits.
Yeah, that makes sense. And Gene, I do think that this is a good place to plug in a quick labor market question. I'm sure you saw the Fed's summary of economic projections, as you've mentioned, and they had unemployment going all the way up to 4.6 by the end of 2023. So that would mean seeing job losses this year if that were to come true. Yet, as you were just speaking to, we have almost 2 job openings for every 1 unemployed person. So, my thought is that we will maybe see the labor market turn over a bit this year, that we will maybe start to see some more job losses. I don't know if it'll be to the extent the Fed thinks, but with more sluggish economic growth, rate hikes, et cetera, my belief is that we would begin to see the labor market loosen up a bit. But Gene, what are your thoughts there? Will we see job losses like the Fed thinks? Will the number of job openings come down? And even for some of our business owners that may be on the call, could it actually get a bit easier to hire people? So any thoughts there?
Yeah, great question. So first of all, I saw a data point that came out yesterday. 20% of companies in the United States expect to be at peak hiring or expect to start to lay off people. So I do think jobs are going to be impacted. But again, we're coming off a very strong foundation. If let's say that the unemployment rate goes from, say, 3.6 to 4.6 or 3.5 to 4. Let's just say it increases by 1%. If you kind of play that through the labor market right now, we've got like 160 million people, 160 million people employed. So you say a 1% increase in the unemployment rate, and I'm doing some assumptions here, but basically it's about 1.6 million jobs lost. Theoretically, with 3 million jobs outstanding, available, yes, there's some skills mismatch out there. I don't think, even if the Fed is right and it goes to 4.6, I don't see it drastically affecting the economy. Yes, things are going to be ugly, especially for people who have lost their jobs, but there are still so many more jobs out there. And again, tech layoffs. People are already saying we're finding jobs already pretty quickly. And to your last question, it will be easier for people, a potential recession makes it easier to find people. So very good. The only wild card, though, is not making investment stock recommendations, but the big retailer announced 2 days ago that they're raising wages on, from $15, I think, to $17 an hour. Again, that pressures earnings, that pressures, profit margins, but it also suggests a very tight labor market. So those are some things we have to watch carefully. So, okay, I'm kind of winding down, but listen, tough first part of the year in our expectation. And I'm not saying the first 6 months. I'm saying maybe the first 5 months. Who knows? But it's not like it's going to be like first 6 months and then the second 6 months. But we're just saying the first part of the year will be a little bit tough as the market's trying to figure out, can we justify high valuations? What's the Fed going to do? And in terms of earnings, where earnings are going to go. But we do expect a better second half. Again, lowered expectations. Disinflation could help the Fed pause. Remember, we talked about the pausing and pivot. Pausing means the Fed stops raising rates. Pivot means the Fed goes from raising rates to cutting rates. The markets expect that to happen. We'll see. I think Peter and I are both on the same page that maybe a pause is possible, but we'll see. And the third point is that maybe we don't have a recession, but if we do, proves to be a mild recession. Regardless of what happens, keep in mind, and as this slide shows, the markets price in events about 6 to 9 months in advance. There comes a point, even if we go towards a recession, that the markets are going to say, well, what comes after a recession? A recovery. The data gets easier to beat. There's less inflation. And what you see here is that, pricing in an expectation, a recovery has shown to be very strong in terms of results. You look here, this shows whether it's large cap, small cap, value, or growth. The first year coming into a recovery has tended to be very, very strong results. All I'm saying is that the market's price in events in advance, and market timing is not the best thing. You could buying when things are really out of favor. It can give you opportunities to take advantage on a go-forward basis. So I know I fumbled that a lot, but all I'm trying to say is that markets begin to price in a recovery eventually. So that's all I have for prepared remarks. Quickly, if you want more information, please follow us on Twitter at CeteraIM. You can follow me on Twitter at Gene Goldman. I think Peter and I want to thank you. I know we'll have some time for questions, but before we turn, I have to show you some disclosures. I will not read every word of this disclosure, but please look at this. It's a very exciting disclosure. So that's it.
Absolutely. Perfect, Gene. And that was fantastic information. And with our bit of remaining time, I'll get to just a couple of additional questions. If you did submit one and we weren't able to get to it, we'll be sure to follow up with you and get that answered. But let's just quickly start with the asset markets and dig in a little bit more there. First with equities, valuations, as Gene mentioned, still a bit high, but across the board, they have come down. For example, I know that small caps are actually trading a fair amount below their 20-year PE average. So, Gene, any thoughts on small cap, large cap, any parts of the equity markets that you like, value versus growth, or even international?
Sure. If you take a big step back, so we love right now, we are overweight value versus growth. Value companies are the companies creating a lot more dividends, a lot more tied towards economic growth, and theoretically, growth companies are really tied to technology. Technology is very cyclical, but technology tends to do better. Growth tends to do better when the economy is really slow, really going down. So long story short, we like value over growth. We were very overweight value versus growth. Now we've narrowed this down to be slightly overweight value over growth. Small caps, we're really attracted to small caps. Small caps are very low valuations. Also, they've been able to avoid some of the strong dollar issues that affected large caps. So we like small caps, we like value. International, we are underweight, but international, we are we're nibbling on that. We're seeing some huge opportunities. Valuations are cheap. You see, like other countries, like the Bank of Canada has paused rate hikes. You're seeing the ECB. You saw some GDP numbers that came out for Europe a couple of days ago, saying that it could be not GDP, PMI numbers that could be better than expected. So everyone has said a recession in Europe. We don't necessarily see that now. So there's some opportunities there. So long story short, value over growth, and we like small cap, and we're starting to look at international more attractively.
Yeah, I would say I'm in alignment there for sure. Moving on to fixed income, bond investors certainly had a rough 2022. Now, I'm personally relatively bullish on the bond market. I mean, we've never seen 3 years in a row of bond losses, and I do believe it's a much better entry point for bonds than what we've been used to. So for those investors who are approaching retirement, they have more allocation to fixed income. Gene, do you think their portfolios are well positioned for 2023? And any thoughts on why we could potentially be a little bit more excited about the bond market this year?
Yeah, I agree. The bond market is usually the boring part of the market, but the bond market, not like last year, the 30-year treasuries down 33%. Worse than the NASDAQ composite. So very, very, very tough year. There are huge opportunities. Just think about it. If growth is slowing down, that's good for bonds. If inflation is slowing down, that's great for bonds. And think about that. Even if, Peter, you and I are wrong, the Fed keeps raising rates, this puts downward pressure on long-term rates. This is really good for long-term bonds. Very, very attractive. Plus, you know what? Bonds are great hedges in terms, they've shown to be historically great hedges to help mitigate against market volatility. You look at 2008, you look at 2020. So we still like bonds, and we think bonds are attractive. In our portfolios, we've been incrementally adding more towards duration. That means interest rate sensitivity, more exposure. The thing that we worry about in bonds a little bit is high yield. I think high yield spreads have widened. You know, you think about economic uncertainty. You have what's called a spread. Credit spread. The credit spreads widen this economic uncertainty because if you own a credit, like a non-treasury bond, you want more compensation because you're taking on more risk. So investment grade spreads have widened. Last year, high yield spreads should widen more. They didn't widen that much. And what we saw is that because there was a lack of new issuance going into the market, so all these buyers of high yield said, you know what, I can't get new issues. I'm going to keep buying the existing issues that are out there, putting downward pressure. We are worried about that a little bit. So something we're watching very carefully about high yield bonds. But overall bonds, we love bonds right now, as you do.
Yeah, absolutely. Makes sense. And then I do just want to quickly get a little bit industry specific. I know there's been, we've received questions about this and the housing market outlook. Gene, I know you talked about that, but just a little bit on the housing market and the future outlook, as well as auto industry in light of higher rates. Where are these headed? And then I'm actually going to add on to that energy prices as well. Do you see energy prices continuing to fall or at least remaining relatively stable?
Okay, let's start with the energy first. That energy is a wild card because China reopening is a wild card. There's a few things that if we have a recession, it puts downward pressure on energy. Makes sense. But the problem is that you're seeing the dollar weaken, which also boosts energy prices because energy is priced in dollars. You're also seeing the China reopening, which will put pressure on energy. So it's a mixed bag. I think oil right now is around $81 a barrel. We don't see it going to like 150 that some people were saying a long time ago. But, maybe hovering in this range between 75 to 90 sounds right, depending on the ebbs and flows of the market. Again, a lot more things going on for energy, but we'll see. Energy, what else were you asking? Sorry, it's been a long day.
Housing and auto.
Oh, housing, auto. So auto, I think autos, you're seeing supply chain, housing and autos, I'll group them together. I think both of them are in a recession right now. Housing is in a recession, prices have come down. Autos are in a recession because the lack of supply chain issues that are starting to get worked through. Remember, the Fed is attacking the demand side of the economy. And then the crosshairs are the two areas most interest rate sensitive. Housing and autos, and it's working. So I know our favorite electric car manufacturer came out last night with some great earnings, which again, I don't really trust the guy, but that's a whole other story. But came in some great earnings and some great data. But you got to say that, if this company is cutting prices and they're saying things are going really well, I don't know. But I do think that auto prices are going to start to weaken a bit, especially with used car prices coming down. I also do think that home prices are not going to be drastic selling, but there will be some more weakness, unfortunately.
Gotcha. Yeah, that's great info. So finally then, Gene, there's a lot of factors clearly that are at work, and we know that each individual has a different situation. Overall, I believe this year is a bit of a transition year. Yes, it could be recessionary. Likely it'll be volatile at times, and many of those challenging factors remain. But my thought is that maybe a transition does happen this year from pessimistic to more optimistic with respect to future sentiment. And we don't want to miss that transition. So, Gene, how do you believe people should view investing in 2023? And then what are the advantages of staying the course instead of trying to market time where the end of the bad will be and the start of the good?
Yeah, a few points to that. So I think, let's say that we do have a mild recession. There's a thought out there that the sell-off in stocks last year, the 20% decline, that's pricing in this year's mild recession. So that could be the case. Maybe maybe we've already seen all the bad news in the stock market, to your point. Second of all, I think market timing, there's the old adage, the Hall of Fame of market timers is a very empty room. And it's true. Market timing is so difficult right now because you have to guess when to get in, but when to get out. And it's always difficult. The best strategy out there, we think, is diversification. I know it's boring. People are like, oh my God, that's my grandparents' strategy. It is so, so important. Basically, diversification is you allocate to different parts of the market. You're diversified. Yeah, you tilt it a little bit, but you have exposure to different parts of the market. It's so important because given the uncertainty, it helps to mitigate some of that volatility, that uncertainty. Because if you can reduce some of the fluctuations in the market, think about this. I think it was what I think I might be off a little bit, like 31 of the last 37 years, stock market has been positive. Good news, upwardly rising market. No, it's like, no, it might be like 24 of the last 31 years, but upwardly rising market. But the average intra-year loss is negative 14%. So now if the market's moving higher, but you have these big losses, diversification can help reduce some of that volatility. So the key thing to diversification is back to you, is that you need to make sure that your portfolio is properly diversified, not too conservative, not too aggressive. That's why you have to stay in contact with Summit, with Casey, with you, to make sure that the portfolios are aligned with long-term investment objectives.
Yeah, absolutely. Makes sense. And Gene, thank you so much for sharing the information and insights that you and your team have put together for 2023. The only other thing that I would add is that we do understand the at times discouraging nature of the markets in 2022. We felt it across the board, but the principle of courage in investing is key to help maximize long-term outcomes. And here at Summit, we're always using these outlooks, such as Gene presented, and the research behind them to inform the strategies we're advising with respect to our clients' investments. And the truth is that markets have bull runs and bear runs, and different asset classes and investment styles will rotate over time. So we always want to make sure a retirement plan has proper diversification offered, and that our clients are properly positioned to have options not just centered around yesterday's winners, but our lineups are forward focused to offer investments that will give diversification when markets shift. So we're here as a resource, and we're here to help you and your employees understand how to navigate the market and be well prepared for their financial future. Additionally, I know our wealth management team is great at incorporating this research into their financial plans and setting up clients to have that income for life that they do desire. So thank you all very much for attending the webinar today. Please don't hesitate to reach out with questions on today's material or any ways that we can be of assistance. So thank you, and I'll go ahead and pass back to Riley for just a few closing remarks.
Thank you, Peter. I'd like to thank Gene Goldman and Peter Reardon for their time and sharing this timely and valuable information with us today. And we would like to thank all of you for joining today's session. Please be sure to follow us on social media if you have any questions from today's session, or if you would like to be connected to a resource at Summit, please contact us via email at marketing@yoursummit.com. But for now, thank you for joining us. Have a great rest of your day, and we'll see you next time.